This year, the S&P 500 has been about as bearish as it gets, with the market briefly hitting a technical bear market last week and many market watchers predicting more of the same. I'm Seth Freuberg, the head trader of SMB Capital's options trading desk here in Manhattan. And the traders on our proprietary trading desk are trained to see these situations as opportunities, not problems. And they're well trained in option strategies to achieve success in any kind of market. In this video, we'll be covering an extremely simple strategy that would have done the exact opposite of what pretty much every equity portfolio is experiencing this year. So if that sounds like something you'd like to learn more about, then stick around, because you're going to be surprised at how easy this could have been done. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Maybe hard to believe, but it's a fact that the S&P 500 was up an incredible 325% in the 10-year period that ended last year, with the index rallying from just below 1,500 to almost 4,800 during that 10-year period. And so anyone who has studied the market historically knows that this is just not sustainable. It's not a sustainable rate of growth in the market, and that the next 10 years are very likely to be a period of much slower growth, with likely sustained periods where we're actually going backwards like we are now, and then have to climb back out of that to experience any growth at all. And so it's in times like these that you have to think a little bit out of the box to continue to achieve positive returns. And in this video, we're going to be going over one of those ideas that's really easy to learn. But before we get into exactly how this strategy works, I wanted to let you know that if you want to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on the direction, then click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause this video, sign up now, and then resume watching. Okay, so now in order to understand how we'll use options to address the likely underperformance of stocks during this upcoming decade, we need to make sure that everyone watching this video understands how put options on stocks work, because we're going to be speaking about trading put options derived from the SPY ETF, which is comprised of a basket of stocks mirroring the S&P 500, as most of you know. Now, if you already know how put options on stocks work, just hang in there. This will be very quick, and then we'll jump back into teaching the strategy. All right, so what's known as a put option on a stock entitles the buyer of that put option to sell 100 shares of a stock that he owns at a certain price called the strike price of that put option, regardless of what price the stock's actually trading at when he exercises that right. The buyer of that put option pays what's called a premium to the seller of the put option, because the seller of the option is taking the risk that the stock will go way below the strike price of that put option, in which case the buyer can exercise his option and force the put seller to buy his shares at the put option strike price, which is higher than where the market is trading, causing the seller's account to get marked down. So even if the market goes way below the strike price of the put option, the buyer of that put has the right to sell 100 shares of that stock at the strike price of that put. So he'll get way above the market price for those shares by virtue of earning that put. And so the premium of the put option reflects the risk that the market thinks the put seller has that the shares will be going much lower than the strike price of that put. So all other things being equal, when a stock price goes down, the price of a put option for that stock will go up, because the put seller's chances of taking a loss because the market's blown through his strike price, gets larger as the stock's price continues to drop. And just one more thing, if on the day of expiration the stock closes above the price of the put option, then that put option expires worthless because no one is going to be exercising their right to sell a stock at a price lower than it's selling in the open market, so it just expires worthless. Okay, so now keeping that in mind, let's say that you pretty logically anticipated that the most recent 10-year rally was going to be hard to sustain in 2022, and so you decided instead to try a different approach to profiting in 2022. So let's now move back to October 22nd, 2021, when SPY stock, which represents the S&P 500, was trading at 453. And on that day, we take a look at an options chain expiring in about 3 months in January of 2022. And we will move to the third Friday of that month, which is January 21st, and sell one of those 385 puts for which we'll receive $287. Now, you may be wondering why we picked that particular option. And the answer is that every online broker that provides access to options quotes will actually give you what is known as the delta of each option that you can trade. And the delta is basically a mathematically determined prediction of how much the options price will move based on how much the stock that options derived from moves, which in this case is the SPY. But there's also a correlation between the options delta and the chances of the stock closing below the put's strike price, which in this case is 385. And so when we trade an option that is around 10 deltas, that means that there's only about a 10% chance, approximately, that SPY will close below 385 the day that this option expires in 3 months. Okay, so now let's move forward to a month later on November 19th. And with the January puts still active, go ahead to the options chain, which expires the third Friday in February. And again, sell the 10 delta put, which for the February options chain happens to be a little bit higher at 395. Which again, with the SPY trading up over 469, the chances of the SPY closing below 395 in 3 months is small. And we'll move forward again to December 17th and do the same thing, selling the 10 delta put, this time at the 380 strike price, which is 80 points lower than the SPY's price at that time, which was 461. Okay, so now let's move forward to January, which is when this current bearish move started. And we'll move forward to the expiration day of the first put that we sold, the January 2022 put. And as you can see, the January puts have expired worthless because SPY closed at 439 that day, while we add the April put position, again, approximately 3 months out. So at this point, every time we add a position, we're going to be dropping off the position that was started 90 days earlier because it's expired. So let's take stock of where we are in January. And as you can see, the January put premium that we received, that became all profit to us because we sold that put for $2.87, and each option represents 100 shares of SPY stock. So you multiply that by 100, and so that $287 becomes pure profit to us. And the rest on the page haven't expired yet, so we don't know the outcome on those quite yet. So now let's move forward to the February expiration, and as you can see, the SPY again closes way above the February put strike price, so that expires worthless, also becoming pure profit. Now moving to March, you see that one also expires worthless with the SPY still way above its strike price, and likewise for both the April and the May. And if you think about it, it makes a great deal of common sense. Each one of these trades had about a 90% chance of expiring worthless from the beginning because we set it up that way, choosing the 10 delta puts. And so it shouldn't be surprising that each and every one of them expired worthless. Okay, so at this juncture, let's update our scorecard. As you can see, each of the trades expired with no value, as we mentioned, and when you're selling put options, the options expiring worthless is actually a good thing, because if they do, you get to just pocket the premium you received as profit. So just think about it. The most capital you would have needed to implement this trade is $116,000, a calculation that we can explain in another video, but it has to do with how much cash you have to have available in your account should you have had to come through on your put obligation to buy the shares if the SPY had closed below all of the put options you sold on their respective expiration days. And so with the SPY down 14% on the year, had you bought SPY shares, you would have been down that 14% versus the slight gain of 1.5% on the 10 Delta puts, which is a swing of 15.5%. In dollar terms, that's a loss of $16,240 versus $1,830, a swing of more than $18,000. And so what I'd like you to take away from today's video is that there's a very conservative alternative to buy and hold equity investing, as most financial advisors would have recommended. Instead, when you're feeling uncomfortable with market conditions, you can begin a program of selling 10 Delta puts, and in most cases, you'll be just pocketing the premiums, as we did in this case. And incidentally, if you do end up being required to buy the shares, they're going to be at your strike price, a price that is always well below where the market was when you first sold the puts, because these are 10 Delta puts, which are always a great distance below the market. So either you're accumulating shares at a large discount from where they were trading 90 days earlier, or you pocket the premium, in many cases outperforming the market, sometimes dramatically, as in this case. And that's why options traders refer to this kind of a put selling program as a win-win situation. And now you've got the knowledge to implement this approach when you are uncomfortable with how far and how fast the market has climbed at some point in the future. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it.